Peter Redward, who's the principal of Redward Associates, joins us from Singapore. Good morning, Peter. Good to have you with us on Morning Mantra. To start with, have you changed your view on India now after the big run-up that we've seen? Could Nifty cross 6,000 before budget?
I don't know that I'd want to pick a level on the Nifty right now. Over the next 12 to 18 months, my view on India is that liquidity conditions will ease, inflationary pressures are coming off. There is room for the central bank to cut rates, and that will provide a tonic for corporate earnings. And India's underlying growth rates and strength are still largely intact. So the market, I think, should tend to move higher. In the very near term, it's possibly a little bit overbought, and there's possibility for disappointment coming from the budget. I think there's a possibility of disappointment coming from the credit policy review as well. It's not clear that the RBI will cut rates significantly, and likewise whether they inject enough liquidity into the system to bring down the overnight rate it remains to be seen.
Right, Peter, then do you think that crude prices could be another risk factor for India, given that the market looks like it's ignoring that particular aspect right now? And what's your expectation from crude prices?
I think crude oil prices are probably going to continue to drift up. The run-up that we've seen in the last couple of weeks looks technically driven rather than fundamentally driven. Obviously there's rising concerns about disruption of supply from Iran and potentially from the Persian Gulf more broadly. So there is a risk that we will see rising oil prices. Now in India's case, rising oil prices are a substantial risk for the country. Obviously running a current account deficit in the vicinity of 3.25% of GDP with something like a 4% plus oil deficit. A rise in oil prices will weigh on the current account. That will take a lot of the upward momentum that we've seen in the rupee out of the market. It will place upward pressure on inflation as well, reducing the scope for the RBI to potentially ease policy. So rising oil prices is a key risk to the Indian story right now.
Peter, what sectors are you liking right now in India? Everything from infra to real estate. The gains are astounding. How are you approaching your investments in India?
I think what you would want to focus on is the sectors that are going to be more exposed to the global cycle. So I think the likes of the software and BPO outsourcing sectors are going to probably provide a better earnings dynamic. I would tend to stay away from the sectors that are still more vulnerable to the domestic story and the construction sector. We've obviously seen a big pickup in those sectors in the last few weeks on the back of improved liquidity flows and expectations of RBI action. But the underlying problems that India faces right now are still there. While the government would like to push a more pro-reform budget and a more fiscal conservative budget, does it have the capacity to actually get that budget passed through Parliament? That's a key risk. The second key risk is on monetary policy. If inflationary pressures don't dissipate, it's going to reduce the scope for the RBI to cut rates. But even that doesn't really solve the problem because of the domestic liquidity tightness. So we need to see signs that the RBI is prepared to step in and significantly increase liquidity supply into the market. And that really means purchasing of government bonds. Intervention in the foreign exchange market is not going to solve the problem. A cut to the CRR will help, but really we need to see intervention in the bond market. And then finally, corporate earnings. Corporate earnings growth has come down considerably, and it's not clear that it will revive strong enough to justify some of the renewed optimism that we've seen in the last few weeks.
Right. And Peter, what's the outlook then for the next 2 months as we've got the elections also underway, we've got the budget that's coming up? How do you think the situation will change for the markets in a base case scenario?
My base case is that we probably see the market consolidate around current levels. We could potentially see a little bit of a pullback. My guess is that we actually see some disappointment coming out of both the credit policy review and the union budget. And and then we continue to muddle through. And it's really not until we start seeing expectations of an improvement in earnings growth that will drive the next leg higher. I think this move higher was really about a recovery in positions, a shift in expectations from an end of the world scenario and foreign inflows into India. That phase is past us now, and it's not clear what happens next.